I brought two receipts. This one says $638 billion. This one says negative $23.7 billion. Most people only look at one. That is how you get fooled. That is the ORCL debate. One number makes Oracle look like an AI winner, $638 billion of remaining performance obligations. The other number makes the stock much harder to value, negative $23.7 billion of free cash flow in fiscal 2026. Both came from Oracle's own reporting. A backlog-only view says Oracle found a new AI superpower. A free cash flow-only view says Oracle turned a beautiful software business into a giant construction project. The truth is more useful than either shortcut. Oracle is a hybrid now, an old enterprise software cash engine on one side, a new AI cloud capacity machine on the other. The question is whether Oracle can convert AI demand into durable owner economics after the data centers are built, powered, leased, financed, and filled. Not hype, not dunking, a conversion test. For newer investors, use this map. Is the business getting more important? Can that importance become cash? Does the common shareholder keep enough after the bill? For Oracle, those are the AI demand question, the free cash flow question, and the debt, lease, equity, and dilution question. Backlog is a promise. Free cash flow is what cleared the register. Do not confuse the two. Keep that rule, then add 4 layers: timing, unit economics, financing, moat. If those layers line up, negative free cash flow can be a construction phase. If those layers break, a giant backlog can still become a mediocre stock outcome. That is the whole tension. Start with the company. Oracle is not a startup, and it is not only the sleepy database name some investors remember. In fiscal 2026, Oracle reported total revenue of $67.4 billion. Cloud and software revenue was $58.5 billion, about 87% of total revenue. Inside that number are two different businesses. The old engine is database, support, applications, Java, middleware, enterprise workflows, and the installed base customers do not rip out casually. The new machine is OCI, GPU capacity, AI workloads, data centers, power, networking, leases, construction, and financing. OCI means Oracle Cloud Infrastructure. In plain English, it is Oracle's cloud platform for compute, storage, networking, databases, and AI infrastructure. The old engine is sticky. The new machine is fast. The old engine has software economics. The new machine requires physical capacity. That split is why Oracle can look boring, explosive, cheap, and risky at the same time. It depends which engine you are valuing. Do not underestimate the old engine. In fiscal 2026, software support revenue was $19.8 billion. Cloud infrastructure revenue was $18.1 billion. Software support alone was still larger than OCI for the full year. That installed base gives Oracle relationships, trust, contracts, and data gravity. It also gives Oracle an AI doorway because enterprise AI is not only about renting GPUs. It is about applying compute to private business data, financial, customer, supply chain, healthcare, HR, and compliance-heavy data. Oracle's pitch is simple. Keep the database close, run it in Oracle Cloud, cloud at customer, dedicated regions, or multi-cloud partnerships. Layer AI where the data already lives. That is the bull case. In one sentence, Oracle does not have to move the customer to the cloud if it can bring cloud economics to where the customer's data already sits, but it is not free. To turn data gravity into a bigger cloud platform, Oracle needs capacity, and the demand side is impressive. Q4 fiscal 2026 revenue was $19.2 billion, up 21%. Q4 cloud revenue was $9.9 billion, up 47%. Q4 cloud infrastructure revenue was $5.8 billion, up 93%. For the full year, total revenue grew 17%, total cloud revenue grew 39%, and cloud infrastructure revenue grew 77% to $18.1 billion. Oracle also confirmed fiscal 2027 revenue guidance of $90 billion and guided Q1 fiscal 2027 cloud revenue growth of 58% to 64%. This is not a no-demand story. Then comes the number that changed the debate. RPO ended Q4 at $638 billion, up 363% year over year and up $85 billion sequentially. That is the number that changed the debate. RPO means contracted revenue. Oracle expects to recognize in future periods subject to contract terms. The beginner mistake is treating it as one bucket. It is a schedule. Oracle's fiscal 2026 10K says that as of May 31st, 2026, Oracle expected to recognize about 12% of RPO over the next 12 months. On $638 billion, that is roughly $76.6 billion. Another 34% was expected over months 13 through 36, roughly $216.9 billion. Another 34% was expected over months 37 through 60, again, roughly $216.9 billion. The rest comes after that. So the RPO story is not just big number, it is a delivery schedule. A reservation is good, a toll booth is better, but only after the road exists. Can Oracle build fast enough, deliver fast enough, and keep enough margin while that reservation book turns into revenue? This timing matters because investors often treat backlog like a finish line. For Oracle, it is closer to a construction calendar. A finish line pays you. A construction calendar sends invoices before the toll booths open. The next 12 months test near-term conversion. The next 3 to 5 years test whether the build-out becomes a durable platform or a rolling capital requirement. Oracle has customers. The harder question is whether Oracle can deliver the reservation book without giving away the economics. That is why the $75 billion GPU detail matters. Oracle said most of the Q3 and Q4 RPO increase came from large-scale AI contracts, where customers either prepaid Oracle for GPUs or supplied the GPUs to Oracle. Prepaid and customer-supplied hardware portions totaled $75 billion. That makes demand more serious. It also tells you what business this has become. This is physical: chips, buildings, land, power, cooling, networking, construction schedules, lease commitments, and financing. Customers are sharing part of the load, but the load is enormous. That nuance matters. Customer help can reduce Oracle's funding burden. It can also make the contracts feel more serious because customers have more skin in the game. But it does not remove Oracle's execution burden. It can make the demand higher quality without making the build-out easy. The data centers still have to be built, connected, powered, cooled, and used at high enough economics. Now convert that into owner economics. RPO has to become capacity built. Capacity has to become revenue recognized. Revenue has to become gross margin. Gross margin has to become operating cash flow. Operating cash flow has to become free cash flow. Free cash flow has to become per share value. Each arrow is a gate. Here's the simple version. Imagine Oracle recognizes $100 of AI cloud revenue. That is not the shareholder's $100. Oracle must run the data center, pay for power, absorb depreciation or lease cost, pay interest, pay taxes, and account for dilution if new equity helped fund the build-out. What remains is the number investors care about. Revenue tells you how much work Oracle won. Survival math tells you who gets paid from that work. Do not ask only how much revenue is coming, ask how much survives. Now look at the bill. In fiscal 2026, Oracle generated about $32.0 billion of operating cash flow, but Capex was about $55.7 billion. Free cash flow was negative $23.7 billion. Capex means capital expenditures, money spent on long-lived assets. For Oracle, think data centers, servers, networking, power infrastructure, and cloud capacity. Negative free cash flow is not automatically bad. Maintenance Capex keeps the machine running. Growth Capex builds a bigger machine. If today's spending creates high return AI capacity, negative free cash flow can be a smart expansion cost. If every new wave of revenue requires another giant spending wave, the business gets harder to value. That is the fair distinction. Front-loaded investment can create a better business. Permanent cash leakage can hide inside a fast-growing one. The step change is dramatic. Capex was about $6.9 billion 2 years earlier, about $21.2 billion 1 year earlier, and about $55.7 billion in fiscal 2026. That is a different capital intensity category. The bill is not only Capex. The fiscal 2026 10K shows $30.2 billion of operating lease liabilities and $7.7 billion of finance lease liabilities. Then comes the line every investor should pause on: $260 billion of additional lease commitments, substantially all related to data center arrangements, expected to commence from fiscal 2027 to fiscal 2029, with terms of 15 to 19 years. Those commitments were not reflected on the balance sheet as of May 31st, 2026. That does not mean they are imaginary. It means the obligation can be easier to miss if you only look at the front page of the balance sheet. A lease commitment is a future rent-like obligation. It may not look exactly like debt on day one, but it can still claim future cash. Oracle also disclosed $13.3 billion of unconditional purchase and other obligations, primarily related to data center power arrangements. After year-end, Oracle entered into an additional $19 billion of unconditional purchase commitments for cloud infrastructure assets. So the correct response to $638 billion of RPO is not ignore it. It is show me the cost to earn it. The bill can be big and still be smart, but only if it buys scarce capacity. Bulls are not claiming the bill disappeared. They are arguing Oracle is building scarce AI infrastructure attached to a sticky enterprise data franchise. If capacity fills, pricing holds, utilization ramps, and database gravity keeps customers in the ecosystem, the data centers are productive assets. But scarce infrastructure still has to earn its cost of capital. And Oracle is financing a very large build-out. In fiscal 2026, Oracle raised $43 billion in debt financing and $5 billion in equity financing. For fiscal 2027, Oracle expects to raise about $40 billion through debt and equity financing, including a previously announced $20 billion at-the-market equity issuance. At year-end, Oracle had $31.3 billion of cash and $129.5 billion of notes payable and other borrowings. Interest expense was $4.6 billion. Dividends used $5.8 billion of cash. Common stock repurchases were only $95 million. That is a different capital return picture from the Oracle many investors remember. Debt means lenders have a claim. Leases mean landlords and infrastructure partners have a claim. Power commitments mean suppliers have a claim. Equity issuance means new shares may share the upside. The common shareholder is last in line. The stock can still work, but returns must be large enough to pay everyone ahead of the shareholder and still leave something attractive behind. This is why a price-to-earnings shortcut can mislead you. EPS means earnings per share, profit per share. GAAP is the standard accounting version. Non-GAAP is management's adjusted version. Non-GAAP can be useful, but you must ask what was removed and whether it is truly unusual. Fiscal 2020 WAR 6 GAAP EPS was $5.83. Non-GAAP EPS was $7.63. But Oracle's own release says fiscal 2026 non-GAAP EPS would have been $6.83, excluding one-time net investment gains. Do not capitalize a one-time gain like it is a recurring business. One more accounting wrinkle: cash leaves when Oracle builds infrastructure. Accounting expense may arrive gradually through depreciation, amortization, or lease expense. So free cash flow can show build-out pressure earlier than EPS does. That does not make EPS useless. It means EPS and free cash flow are answering different timing questions. Now margins. Oracle's full-year GAAP operating income was $20.6 billion, up 17%. But cloud and software total margin fell from 63% in fiscal 2025 to 59% in fiscal 2026. Oracle's 10K says the constant currency margin percentage declined because of higher infrastructure expenses to support cloud infrastructure growth. Growth is real. Growth is also infrastructure heavy. That is the hinge. This is not growth versus no growth. It is growth with operating leverage versus growth with rising capital intensity. If utilization rises and pricing holds, today's pressure can become tomorrow's operating leverage. If AI compute becomes a capacity race, revenue can grow while free cash flow stays pressured. The first number says customers want it. The second number says Oracle must build it. The third number is what shareholders keep. Now bring back the moat. Oracle's strongest bull case is not that it suddenly became fashionable, it is enterprise data gravity. Companies have spent decades building around Oracle databases, applications, Java, middleware, and support contracts. Core systems do not move because a competitor has a nicer slide. They move when performance, security, integration, cost, risk, and timing all line up. Oracle's strategy is more specific than come rent compute. Keep your Oracle database, bring it to Oracle Cloud, run it near your apps. Use cloud at customer or dedicated regions if needed. Use multi-cloud if the rest of the stack is already near Microsoft Azure, Amazon AWS, or Google Cloud. Use AI where the data already lives. The moat test is whether AI makes Oracle's installed base more valuable. Competition is real. Microsoft, Amazon, and Google have massive cloud platforms, developer ecosystems, global data center footprints, capital, AI partnerships, and customer relationships. Oracle does not need to win the entire cloud market. It needs to win the right workloads at the right returns. Oracle database-heavy workloads, dedicated region, or cloud at customers, applications in another cloud where the database still needs Oracle performance, available capacity, where customers help fund or supply hardware, and lower friction around existing Oracle workloads. That is the important bar. Not Oracle beats every hyperscaler, more like, can Oracle become unavoidable in the subset of enterprise AI where Oracle data, Oracle databases, and Oracle infrastructure are tightly connected? If yes, the company does not need to be the biggest cloud to create value. If no, the build-out risks becoming another expensive participant in a market where the largest hyperscalers set the economics. The bear case says AI infrastructure becomes a brutal scale game, returns get compressed, GPU capacity commoditizes, and the old moat does not transfer cleanly to the new layer. Both sides are plausible, so we need tests. One more operating note. Oracle employed about 141,000 full-time employees at May 31st, 2026, down from about 162,000 a year earlier. It also recorded $1.8 billion of restructuring expenses tied to strategic measures and AI-related operational efficiencies. That does not prove AI magically improves profitability. It shows Oracle is doing two hard things at once: building physical AI infrastructure while changing parts of the workforce and operating model. Now the bull case, cleanly, Oracle has found a second life. AI changed the demand curve for compute. Capacity, networking, database gravity, and enterprise data suddenly matter more. The RPO surge signals long-term customer commitments. Customer prepayments and supplied GPUs reduce part of the funding burden. The database franchise gives Oracle a differentiated route into enterprise AI. Negative free cash flow is temporary because capacity is being built ahead of revenue. Fiscal 2027 revenue guidance of $90 billion becomes the first major conversion test. If Oracle reaches scale, operating leverage can be large. Now the bear case also cleanly, the market may be too impressed by the reservation book and not focused enough on timing, margin, and financing. To earn the RPO, Oracle needs data centers, chips, power, leases, and financing. Capex already exceeded operating cash flow by a wide margin in fiscal 2026. Debt, lease commitments, and possible equity issuance changed the balance sheet. AI infrastructure may become capital intensive and competitive with returns below what the backlog headline implies. The old software cash engine is now attached to a riskier infrastructure race, so we do not guess, we watch the tests. The point of the tests is not to predict the next quarter perfectly, it is to prevent one headline from doing all the thinking. 6 spacious proof boxes appear left to right: RPO to revenue, OCI growth to margin, Capex to free cash flow, financing to per share value, contract risk controlled, and database moat strengthened. Test 1, RPO must convert into revenue on schedule. Watch fiscal 2027 revenue against the $90 billion guide and watch whether the 12-month, 13 to 36-month, and 37 to 60-month RPO schedule stays intact. This test strengthens if revenue ramps without constant schedule slippage. It weakens if the RPO number stays impressive, but conversion keeps moving farther into the future. Test 2. OCI growth must come with margin stabilization, not just bigger infrastructure spend. This strengthens if cloud and software margin stops deteriorating while OCI keeps scaling. It weakens if growth is strong, but every incremental dollar requires more infrastructure expense than expected. Test 3, free cash flow should improve while revenue grows, not because Oracle starves the build out. This strengthens if operating cash flow rises and Capex becomes more manageable relative to revenue. It weakens if free cash flow improves only because Oracle slows investment and risks missing demand. Test 4, debt, leases, interest, power commitments, and dilution cannot grow faster than the cloud cash flow opportunity. This strengthens if financing needs peak and the balance sheet starts absorbing the build-out. It weakens if debt, leases, or equity issuance keep expanding faster than visible cloud cash flow. Test 5, contract risk must stay controlled. No single customer accounted for 10% or more of total revenue in fiscal 2026, 2025, or 2024. But future backlog concentration is a different risk from current revenue concentration. This strengthens if large AI customers keep using, funding, and honoring the capacity Oracle is building for them. It weakens if a small number of large arrangements drives too much of the future infrastructure plan. Test 6, AI must make the database moat stronger, not weaker. If AI pulls enterprise data away from Oracle, the old moat weakens. If AI makes Oracle's database and cloud ecosystem more important, the moat strengthens. That framework should still matter years from now. If you are watching in 2027, 2028, or later, rerun the same tests with the latest filing. Did RPO become revenue? Did OCI growth hold? Did margin stabilize? Did free cash flow recover? Did debt, leases, and equity issuance become more manageable? Did the database moat become more valuable because of AI? The exact numbers will change. The framework should not, because the framework tracks the conversion, not the headline. If the road fills up, the bill makes sense. If it stays half empty, the bill becomes the story. Cleanest view of Oracle: demand exists, profitability exists, the database moat exists. The unresolved question is whether the new AI infrastructure machine can produce returns that justify the bill. The bill is too large to ignore. The demand is too large to dismiss. Oracle is trying to convert an old enterprise software franchise into a new AI infrastructure platform, and the conversion is being paid for with one of the largest data center commitments in the market. If that works, Oracle may deserve a different conversation than the old database stock label. If it does not, the RPO headline may have pulled investors toward a business that became more capital intensive than expected. Final scoreboard: timing, survival, burden, and wedge. Timing: does RPO become recognized revenue? Survival: does $100 of AI cloud revenue leave enough after operating cost, power, depreciation, leases, interest, taxes, and dilution? Burden: do debt, equity, power, and lease commitments stay smaller than the cloud cash flow opportunity? Wedge: does database gravity give Oracle a real place in enterprise AI, or do the economics drift back toward the larger hyperscalers? Oracle has the demand receipt. Oracle has the construction bill. The next few years decide whether this becomes a toll road or only an expensive road. That is the cleanest way to judge the stock. Not the size of the reservation book, but the spread between tolls collected and capital claims required to build the road. Educational only. No buy, sell, or hold recommendation.